Good morning, afternoon, and evening to all. I am Dr. Nnamdi Ibokwe, Director of Knowledge and Thought Leadership at Convergence Blended Finance. We are here today to present to you our annual State of Blended Finance report. Before we begin, a few housekeeping items. This event is being recorded, so please take note of that. We will share that recording with all participants following the event. As we get started, we ask that you rename yourself to display your full name, your institution, so we know who we are interacting with and who's on the call. We have a rather large attendance today, so do remember to keep your cameras off and kindly remain on mute. We're going to have two Q&A sessions, so please utilize the chat function during that time to pose your questions. And finally, if you're looking for the report, it's currently available for download on our resources page at www.convergence.finance/resource, or you can scan the QR code on your screen. There you will find the report along with other useful material. So a quick overview for the agenda for today. We have 90 minutes for our event. I'll start with a few opening remarks and then turn it over to the authors of the report, the content team, to present key findings. Following that 20-minute presentation, we will open up the floor for questions. And immediately following that Q&A, we will have an incredible panel discussion featuring 4 brilliant and expert voices from the community of blended finance. You'll also have an opportunity to pose questions to the panelists directly. We will then wrap things up with some closing remarks from our CEO, Joan Larea. So to start off, and to make sure we're all on the same page, just quickly, what is blended finance? So when we at Convergence talk about blended finance, we are referring to any kind of use of catalytic capital. This can come from philanthropic institutions or development agency to increase private sector investment in sustainable development in developing countries. Now, we published this annual report that looks at the state of the blended finance industry by adding transactions to our historical deal database that match that definition, and by engaging in a series of expert interviews. We began this process in 2017, making this our 7th edition and our 2nd consecutive climate-focused report. So why climate, you might ask? Well, we chose to produce a climate report last year for several reasons, some of which are, one, a large portion of blended finance activity touches climate directly, and you'll hear some of those statistics during the presentation. And two, climate finance is an area, or the area, where private sector investors, particularly institutional investors, have indicated a great willingness to invest alongside the public sector, alongside public capital, and enter developing markets. So given that reality, we will be maintaining the climate theme, but we also like to announce that we'll be introducing 2 State of Blended Finance reports annually. So starting in spring 2024, the dual report cycle will begin with a report that looks at the entire blended finance market. Then fall 2024, a 2nd climate-focused edition will be released. So we look forward to those upcoming reports, but we focus our attention today on the 2023 State of Blended Finance Climate Edition. So just a quick overview before we get into the presentation outright and the key findings. So we know that funding targets for climate finance in emerging markets and developing economies have not been met. The data and trends that will follow reflect that reality, that financing levels are not moving in the right direction. But what we've tried to do in this report is also highlight specific circumstances where blended finance can immediately contribute to mobilize private sector investment in climate. Also want to highlight opportunity areas and sectors that are ripe for private investments. And we specifically take a look at country-level and country-led partnership platforms that align with the unique demands and composition of emerging markets and developing economies, and trying to understand what that blended finance architecture should look like. And with that, I will turn over to my colleague, Robin Ivory, to begin the report presentation.
Thank you very much, Nnamdi. Over the next 5 minutes or so, I'll be walking us through some overall deal trends that are highlighted in the report. I'll start off by looking at which transactions our data includes. So next slide, please. As was previously noted, this report focuses on a subset of transactions within our HDD. The HDD currently contains over 1,000 transactions, and of these, this report looks at 485 climate-focused deals. This accounts for a little over half of the total market size, which is equal to around $109 billion. Despite capturing a similar deal count in 2022 as compared to the previous year, we found that total deal volume decreased by approximately 45% and about 55% in climate blended finance, which is a 10-year low in total financing. Moreover, in 2022, climate blended finance transactions accounted for under 40% of all blended finance deals. In contrast, in each of the previous 5 years, climate-focused transactions accounted for 50% or more. Moving on to the next slide. Here we see the sources of capital for climate blended finance transactions. From 2017 to 2022, private sector investors were the main source of capital to climate blended finance transactions by volume, investing an average of $2.3 billion in commercial capital. However, private sector climate financing totals have recently plateaued. Additionally, we observed that financing from the DFIs and MDBs dropped by 3% from 2017-2019 to 2020-2022. In terms of concessional investment deployed to mobilize commercial investment, ODA allocated by OECD DAC members averaged about $1.3 billion per year from 2017-2022, while concessional investment from non-ODA sources averaged $675 million per year. Notably, the supply of concessional capital to climate blended finance deals has been stagnating since 2017, and as was previously mentioned, is nowhere near the levels required to reach key mobilization targets. Next slide, please. Overall, this report looks at climate blended financing through 3 different lenses: mitigation, adaptation, and hybrid transactions. Most climate blended finance by both transaction count and aggregate financing volume is focused on mitigation. Since 2013, approximately 58% of the annual climate deal count within the HDD is exclusively focused on mitigation. This represents more than $64.2 billion in total mitigation finance. Blended mitigation deals also tend to be the largest type of the 3, with the median deal size over this period being $90.9 million versus $43 million for hybrid and $34.5 million for adaptation. Moreover, blended mitigation deals have a higher leverage ratio of 6.1 compared to 3.9 for hybrid and 2.7 for adaptation. Historically, adaptation deals have struggled to attract investors because there's an ongoing perception that adaptation deals are riskier and present lower financial returns. Moving on, we'll now take a look at the vehicles through which climate blended financing has flowed. Apart from 2020, project transactions have been the most common transaction type on an annual basis over the past 6 years, on average comprising 40% of climate blended finance deals per year. Blended funds for climate have declined noticeably in recent years, comprising just 11% of climate blended finance deals in 2022, and this is down from 26% in 2017. The downturn is symptomatic of the macroeconomic factors challenging the wider investment industry. Blended bonds have yet to gain significant traction or scale. Despite them accounting for a progressively greater portion of annual blended climate financing volume since 2017, climate-focused bonds have only accounted for 11% of climate blended transactions per year on average between 2020 and 2022. Lastly, we'll look at where climate blended finance is being directed. So we can move to the next slide. The largest portion of climate blended finance transactions have targeted sub-Saharan Africa. In the 3-year periods shown in this graph, the proportion of transactions that were focused in this region grew 14 percentage points, while East Asia and the Pacific decreased from 20% to 13%. Regarding financing volume from 2020 to 2022, while Latin America and the Caribbean was the second largest region by deal count, it was the largest region by financing volume. This is because while transactions in sub-Saharan Africa tend to be more frequent, they are also generally smaller. Looking ahead, Southeast Asia and South Asia will be increasingly important regions in the fight against climate change, given their dependence on coal. Coal plants in Asia and the Pacific account for 1/5 of global emissions, and the dependency on the commodity is expected to continue. Further deal trends can be found in the report, including the use of blended archetypes, and I encourage you to take a look. For now, I'll pass it over to my colleague, Nick, for a look at investor trends.
Thank you, Robin. So as mentioned, I'll briefly be going over some of the key takeaways from this year's report regarding investment behaviors and the investor trends in the climate blended finance space. Next slide, please. So investment into climate blended finance transactions remains an ad hoc activity across investor groups, especially among private sector investors. Historically, more than 75% of investors have made 2 or fewer investments into climate blended finance deals. That being said, however, more than 50% of all historic investments into climate blended finance have occurred in the last 5 years, signaling some degree of uptake among certain investors. So as can be seen here on the two bars on the left, we have seen little change in the composition of how blended finance deals are being funded, with commercial investors providing the most commitments, followed by DFIs and MDBs, and then development agencies. Where we are seeing noticeable change is in the supply of concessional capital to these deals. So since 2020, development agencies have provided about 2/3 of concessional instruments to climate blended finance deals, up from about 55% between 2017 and 2019. And when we look at just adaptation deals alone, development agencies are even more relied upon, providing nearly 3/4 of concessional commitments. Next slide, please. So here we see that climate transactions with an exclusive mitigation focus receive most of the attention across all the investor classes. DFIs and MDBs are the most heavily skewed towards mitigation deals, with nearly 2/3 of commitments going towards such transactions. And they are also the least engaged in adaptation deals. We do see some evidence of DFIs and MDBs adopting market proving strategies in the adaptation space. So this is where deals are prioritized, where the social and market externalities are the central outcome, apart from just solely focusing on leverage and mobilization numbers. Finally, foundations are developing a track record in adaptation blended finance as well, and are the only investor class with more than 50% or half of investments directed towards transactions that have integrated at least some degree of an adaptation focus. So that's adaptation deals combined with hybrid transactions. Next slide, please. So according to Convergence investment data, public sector investors have far outpaced private sector investors in terms of financing volume. Since 2017, public sector investors have provided an annual average of $2.3 billion more than the private sector. Public sector flows are also increasingly driven by DFIs and MDBs, with median investment size growing from about $10 million in 2020 to almost $20 million in 2022. On the private sector side, which we will dive into shortly, financial institutions and corporates provide the bulk of commercial financing. And Convergence anticipates private and public sector financing levels to grow to about $2.1 billion and $4.8 billion respectively in 2023. Next slide, please. Since 2017, Convergence has captured about $13 billion of private sector investment into climate blended finance deals. Over that time, corporates and financial institutions combined have provided over 2/3 of all private sector commitments to climate deals. Private sector investment was greatly impacted by the COVID-19 pandemic, and something that we did bring up in last year's report. For example, allocation totals from corporates dropped by 90% in 2020 from 2018 totals. And likewise, committed capital from institutional investors fell by nearly 40%. Convergence did observe a rebound in investment activity across almost all the private sector investor classes in 2021, but emergent macroeconomic challenges in 2022 have once again restricted that investment activity, presenting unique challenges to each investor type, and is something that we do bring up in depth in the report. Finally, Convergence believes that concessional capital providers must more intentionally target the institutional investor class. So that means using those below market instruments or concessional instruments strategically to pinpoint the primary risk concerns in the internal limitations of institutional investors. Our historical data does show that institutional investors are open to hybrid and adaptation opportunities, meaning they are an untapped source of critical adaptation financing. So I'll now pass it over to my colleague, Andrew Pompa, who will go over how blended finance can directly contribute to the challenges facing climate blended finance in achieving scale.
Thank you, Nick. In last year's report, we identified different challenges to achieving scale within climate blended finance. These included challenges in coordinating and implementing high-level capital mobilization plans, difficulties in managing development trade-offs, and low levels of participation from investors domiciled in developing markets. While these challenges and others persist, This year's report explores 6 different areas where blended finance can directly contribute. I'll focus on 2 of those areas in this presentation. First, blended finance can help to frame country-level platforms and partnerships more effectively. The creation of country-level mechanisms that can foster collaboration and a shared focus between governments, leverage and connect private finance with climate-aligned projects, and coordinate and channel technical assistance is an example of how the international finance architecture can change to help mobilize the private sector for climate. This year's report provides a deep dive on the just energy transition partnerships. The JETPs help coal-dependent developing economies transition towards renewable energy sources, while supporting affected communities by investing in social initiatives like alternative job creation and training. JETPs are supported by donor countries within the International Partners Group who provide the concessional capital needed to de-risk investment in the energy transition. Blended finance can directly contribute to the framing of large initiatives like JETPs, which represent an interlinked set of actions by a multitude of parties. A blended finance approach can help to address the key challenges that the JETP model has faced, such as concessional resources being misdirected towards areas that can be financed by the private sector, and different donors having competing agendas within individual JETPs. Of course, blended finance is a structuring approach that places parties into specific roles that line up with their mandates. In thinking of a JETP as a meta blended finance transaction, those leading their design may find a ready language for identifying the requirements and motivations of each of the players and separating actions into those best taken on by national governments, community leaders, investors, and international bodies. Overall, country-level financing platforms underpinned by blended finance risk-sharing frameworks can help to align national development priorities, climate policy initiatives, and global financing ambitions. Secondly, blended finance can help to reduce financing costs for firms domiciled in developing countries investing in a climate transition through national green banks. National green banks can help to address a key challenge that we identified in last year's report, that is, low levels of coordinated participation from investors domiciled in developing markets. Local institutional investors have an intimate understanding of local investment landscape, which may make them better placed to assume the operating risks in local transactions. Their ability to invest in local currency can also provide financing solutions that are more flexible and sustainable for projects generating local currency revenues. However, up to 90% or more of the climate investment that many developing countries receive originates from foreign sources, and specifically through bilateral DFIs and MDBs, where developed country government shareholders exert more influence. National green banks focused on domestic green investment in emerging markets can help to address the challenges in raising the cost of climate project financing for local private investors. They offer a degree of latitude in designing and implementing interventions and a focus on cost effectiveness and performance. They can also be created as standalone institutions or, where possible, integrated within DFIs to leverage existing infrastructure. So, for example, the Climate Financing Facility is a specialized lending facility and green bank housed within the Development Bank of Southern Africa, which is designed to increase private investment in climate-related infrastructure projects in the Southern African development community. National green banks can leverage their local expertise by developing innovative finance and market development solutions, from providing credit enhancements via loan loss reserves or loan guarantees, providing technical assistance, and underwriting and then aggregating small-scale loans that can then be sold to the private sector. In the report, Convergence makes specific recommendations on how climate-blended finance can achieve scale. And to talk about that, I'll hand over to my colleague, Aisha.
Great, thank you, Andrew. So based on our report findings, Convergence highlights recommendations for how climate-blended finance can drive private investments at scale. So I will cover 3 of those today. So our first recommendation pertains to the role of MDBs and DFIs in advancing climate-blended finance. So firstly, MDBs and DFIs should integrate climate and private sector mobilization KPIs into their operating models and prioritize forward-looking data and analytics. As discussed earlier, MDBs and DFIs are the largest source of public funds into blended finance and the most active investor set, and thus have a critical role to play in scaling blended finance for climate. So within the larger context of MDB and DFI reform, Convergence advocates the need for shareholders to establish a set of strategic KPIs that would prioritize third-party private sector mobilization, and secondly, climate mitigation and adaptation goals. So for example, instituting measurable KPIs, such as the reduction of GHG emissions or the number of communities made resilient to climate-induced changes, will improve accountability and better align with global climate objectives, allowing these institutions to track contributions to climate financing effectively. Further, there is a need to rethink data and analytics paradigms, and MDBs and DFIs are ideally positioned to spearhead a move towards more forward-looking analytics. So there's a need for more predictive data that accurately captures the nature of climate risks. So development banks need to adjust their data and analytics for the reality of future climate change, and they also need to require this data and analytics in the projects that they fund. Lastly, MDBs and DFIs must deepen their partnerships with national development banks to align on local climate plans. By working closely with national banks, MDBs and DFIs can ensure that their strategies are in harmony with local climate needs, leveraging their global perspective and resources to magnify the impact of localized efforts. The second recommendation that I'll highlight today is the need to incorporate and integrate philanthropic capital as catalytic funds. So traditional donors have always been at the forefront of blended finance as the providers of concessional capital, and we saw that in some of the statistics that we previewed earlier. However, integrating more philanthropic capital offers an untapped but important source of catalytic funds. So philanthropic institutions often have greater flexibility and capacity for risk-taking within their financial toolkit and have an inherent goal of creating social impact. So because of this, they have the potential to act as true catalysts and bridge gaps that other forms of capital can't. However, our data tells us that between 2017 and 2022, philanthropic organizations provided just 10% of all concessional capital commitments to climate blended finance. So this really tells us that there is a large but an unrealized opportunity to expand their participation in blended finance. And we think that philanthropic capital can play a critical role in supporting mobilization targets if deployed at scale. The last recommendation that I'll run through is empowering LDCs in championing bottom-up approaches. So we recognize that the prevailing top-down approach to country financing platforms often prioritize global climate aspirations and overlook the unique perspectives and the expertise present within local LDCs themselves. And so we do recognize the need to redirect the focus that better reflect the on-the-ground realities and priorities. So in our report, we do highlight some of the proactive efforts that have been made at the country level to engage the investment community and how local governments have played an important role in boosting pipeline development and attracting commercial capital. Showcasing successful initiatives, presenting clear data on returns, and demonstrating government support can serve as really important signals to the broader commercial investment community. So we need to recognize LDCs and local countries as partners with insider insights rather than just as recipients of flows, and empower them to spearhead more inclusive climate finance country frameworks. And we expand upon that in the report. So with that, we're now going to move into our first question and answer period with the content team. So we ask participants to please direct questions into the Zoom chat, and the content team is here to respond to any questions that you might have. So it looks like we have a couple questions filtering into the Q&A. So we have one question that is regarding what types of blended finance has been most effective to catalyze blended finance amongst the different blending archetypes that we see, and also how and where blended finance can best catalyze private sector capital. So I'll just open the floor to the content team in case anybody wants to share, maybe where we've seen the greatest leverage from our archetypes, and also, where we see blended finance having the greatest opportunity to scale private investment.
Yeah, so maybe I'll jump in and try and address that question in terms of what has been the most effective. Our data has shown, and what we've learned is concessional capital has been by far the most the leading archetype, if you will, in terms of catalyzing blended finance on the debt side and also on the equity side. Regions like Sub-Saharan Africa constantly stick out, and we also see Latin America and the Caribbean increase activity as well. Sector-wise, mitigation is always led. Renewables and energy seems to be, the strongest performer in terms of where blended finance exists in the climate section in the sector. Also in terms of guarantees, there is a lot of excitement again around guarantees, a lot of potential for guarantees. We see mobilization numbers, and there is a potential for guarantees to be effective. We actually did a deep dive into guarantees with CETA a year ago, looking at sort of the contours around what it takes to, provision a guarantee. And we do strike a bit of a warning that it's not something that should just be jumped into, but that is an area that we do see some potential in terms of catalyzing the private sector. And I'll also add that in the report, we go into the hybrid section of climate blended finance. So the mix of adaptation and mitigation, where we see some promise for larger private sector participation.
Just also to add on that point, Nabdi, in terms of what concessional instruments do we see the most of? So if we kind of unpack concessional debt and equity, we see senior debt priced concessionally. So what we call concessional senior debt to be quite by far the most frequently used concessional instrument in blended finance transactions, including in the climate blended finance space. So just to add that point as well, and that's delved deeper into in the report.
So we have a question here on the definition of what hybrid deals are. I wonder if someone from either Nick or Robin want to comment on how we've defined hybrid in the report.
Sure, thanks, Aisha. I can jump in there. Hybrid transactions are those that contain elements of both mitigation and adaptation. So we have included some examples of hybrid deals within the report. So for example, just start pulling them up here. So there are opportunities that they, like I said, combine adaptation, mitigation. So there's one, for example, called the Planting Climate Resilience Project. And this is a project situated in northeast region of Brazil. And they improve smallholder farmer productivity on degraded ecosystems. So they contain both elements of mitigation and adaptation. So mitigation, they introduce low emission technologies to increase farmer productivity. And adaptation, they'll focus on producing climate resilient agriculture. So hybrid transactions can also refer to overall sectors. We see most of those are based in, again, agriculture, because that's a sector well suited to contain both of those elements. And I think there was another question kind of combined with this one, if I saw correctly. Aisha, did you see? Oh, an example of blended climate focused bonds. So yes, we do provide blended finance bond examples as well within the report. One of them we actually did a case study on. It was a blue bond in Belize. And so I encourage you, we can post the link to that as well in the chat. So you can take a look at that. And I don't know if Nick, you want to jump in anything as well.
No, I think that pretty much covers it. In terms of blended bonds as well, I think a notable one that also looks at the gender climate nexus is the IIX Women Livelihood Bond 4. So we also have within one of our summary case studies where we look back at our entire case study portfolio, we kind of delve again into those transactions and break down how that concessional capital was used in terms of both enticing the private sector to investing in opportunities that otherwise they wouldn't, and also how it kind of buffered some of the returns there as well.
So, we're getting quite a few questions, just trying to filter through. I see an important one that we get all the time, and that is, have overall blended financing um, followed the same trend as we're seeing in the climate finance sector, i.e. what is contributing to sort of the downtrend. We've, from last year's report, we noted that there is a downtrend, and this year continues that trend as well. There's a couple of ways I'll try and answer that question. So in terms of the broader global macroeconomic environment, these shocks contributed to declines, across the board, across the investment landscape. So although climate financing broadly might show increases, their growth rate is actually declining. And we see that mirror in the regression that we've outlined in the report in terms of climate blended finance. But to go along with that and understanding maybe why this is happening, it's important to reiterate that blended finance is not a silver bullet. We say this all the time. It's a tool to de-risk and mobilize investment, right? So it can balance the risk return of a transaction, but it can't cover up for a business model that fundamentally doesn't capture economic value. So we have to sort of understand what we're assessing with blended finance and why we see these sort of numbers coming down. And in addition to that, there are some conditional elements, right, that go into assessing the performance of blended finance over the last few years. For example, the availability of and the deployment of catalytic capital. Like, this is necessary for blended finance structures to succeed. So as we're trying to understand why we're seeing this downtrend and how capital is sort of being redirected and maybe not performing to the levels that we had seen prior, there are larger macroeconomic issues at hand. And it's a fair question to sort of negotiate, but the answer doesn't exist in isolation, right? So we have to also ask additional questions. Does catalytic capital, do the providers of catalytic capital have the intention of mobilizing the private sector? We might also ask, given the paucity of catalytic capital generally, have we fully optimized the use of the little that is available? So we go into this in the report. There's a section on sort of what is contributing, but we should keep that in mind, that assessing blended finance in the way that we expect it to perform also requires other sort of conditionals that feed into the larger structure or the larger look at blended finance.
We have a couple questions that are pertaining to the relatively small proportion of capital coming from philanthropics, and some of the reasons why, and also the opportunity that exists there. So I think it's important to comment that blended finance hasn't been seen as a strategic approach for most investor sets. It's really, I think, most baked as a strategic goal currently into the development community, and as a way of utilizing official development assistance, and a way that MDBs and DFIs can also de-risk investments using ODA to reach some of those riskier sectors. So I think it's a reflection of sort of where blended finance sits in the toolkit, and is recognized as a more strategic approach. But one thing that we really comment on in the report is the fact that the share of concessional capital, mainly being provided right now by the donor community, is not increasing. So we're seeing that share of capital really stagnate year on year. So that really means either to increase blended finance, we have to increase the share of concessional capital going into blended finance, or we need to be much more efficient and get our leverage ratios much, much higher. So Convergence has put out a leverage ratio this year that shows about a 1-to-4 ratio. So for every $1 of concessional capital, you have $4 of commercial capital that's crowded in. We really need to raise that number. So I think philanthropics here represent a really important source of how to increase that amount of concessional capital that's entering the market, but also how can we be most judicious with this very sparse funding coming from ODA and philanthropics to be awarded the most efficient and to the best ideas in the market. So I think that's a very important point that we reflect on in the report.
Yeah, just to buttress that, integrating philanthropic capital is going to be critical. It's often the most flexible, the most patient, the most risk-taking form of capital out there, if you consider the social impact that goes along with it. So, as Aisha mentioned, we have a section in the report that speaks to this directly, but understanding how we can expand that pool by integrating philanthropic capital is going to be highly important in terms of, being true catalysts to sort of bridge, the gaps that we've been seeing. do we have time for more questions? I know they're still coming through and we're filtering them now. Just want to make sure we still have time.
The content team will respond to the questions in the chat online while we move into if we want to move on to the next part of the presentation. So keep the questions coming and the content team can continue to respond.
Okay, and with that, we'll move on to the panel segment of our presentation.
Thank you, and I encourage the panelists to go ahead and turn on your video. Welcome, hi Jay. I know that I saw Cecilia and Stephanie also, and Terry, so come on camera. So thank you very much everybody for being here. My name is Joan Larrea and I am the CEO of Convergence. And loved all the questions we've gotten so far. Many of them are actually answered in the report. So please feel free to download it and we welcome your comments. So I am delighted to have the opportunity to bring into this conversation a couple of voices that you will have heard in the report. They include Citi, and that will Stephanie von Friedeberg will be bringing us some comments from the perspective of the very heavily regulated and institutional investor community. We also have a speaker, Cecilia Tom, from the International Energy Agency, who can speak to the scale of the challenge of getting investment into climate finance. Moreover, we have Jay Coe from Lightsmith, which is a fund manager that has been leading on investing in adaptation. And finally, we have a voice from the Ministry of Finance of Rwanda, representing the view of a country and a specific developing economies agenda to dealing with climate change. As a reminder, Convergence focuses on emerging markets and developing economies, not on all geographies. And we recognize that climate finance goes well beyond the areas that the geographic areas that we focus on. We also examine typically only blended finance, which is, of course, the strategic use of concessional or below market rate capital to attract private sector investment into and within these economies where we focus. So we realize that we're dealing with a subset of the larger world. And I encourage the panelists in the audience to help us think through this specific space, blended finance for climate in the emerging markets and developing economies. We're going to have a Q&A, so please be prepared to raise your hand or please start putting questions in the chat channel. So if I can invite you all in, Stephanie and Terry and Cecilia, do you also have your cameras on?
Yep, mine's on.
Okay, I can't see everything for some reason, so I will go on faith. Let me start, Stephanie, with you, and I'm delighted to have you on here. For those of you who may recognize Stephanie's name, she comes from a long career at World Bank IFC before going over to Citi, and I've had the pleasure of knowing Stephanie since we were both tadpoles in business school many years ago. So wonderful to have you with us. So in the report, we mention that the 30 largest global commercial banks have cumulatively committed annual climate financing of $870 billion per year going forward. So given the regulatory and the fiduciary challenges that private sector investors like Citi face when considering climate-focused investments in developing economies, how do you think blended finance can help overcome the barriers and attract investment at scale? I mean, which blended finance structures are particularly relevant for Citi, for example? Would you like to kick us off?
Yeah, Joan, thank you very much. And I actually feel like an old frog now, if we were tadpoles a while back. But it's great to be here. And, you've asked me a question that I have been absolutely fascinated by since I joined Citi 9 months ago. And, having spent 30 years in an unregulated organization, the layers of regulation that bind the large money center banks is staggering, to be honest. And we really have to start at the bottom, which is kind of post-financial crisis in 2008 and 2009. Basel regulation tightened very substantially. And then as Basel regulation tightened, in the G7 in particular, the national regulators within each one of the G7 countries made their own interpretation of Basel. And then to be extra cautious, the banks themselves have built out very large compliance organizations to make sure they're being compliant with their national regulator and with Basel. And so what you see is an inability for any of us to finance the long-tenured climate projects that are necessary in emerging markets. And when I joined Citi, Jane Fraser had made $1 trillion commitment of sustainability between 500 billion climate and 500 billion more social. In order for us to get there, we know we have to be in emerging markets, but we're not going to get there in the current regulatory environment. So my first thought was, well, we should be partnering with the MDBs that you all have been talking about in the first part of the presentation and use their risk defeasance tools. What's very interesting about that is that as I dig in with our own risk teams and I look at how regulators have interpreted that, we've taken taxpayer money from the G7, created these incredible development institutions so that they can create risk diffusion tools to crowd in the private sector. And then the regulator has turned around and said, nope, they actually don't diffuse risk. So your risk-weighted assets, or the capital that you need to set aside, even when you're under the umbrella of a MEGA guarantee, for example, is 100% in emerging markets, which makes it so punitive that we won't be able to finance those transactions. So we ultimately are going to need regulatory change. In the interim, I think blended finance is the way for us to begin proving out that money center banks and large banks in the G7 can actually be investing in emerging markets. And I kind of look at that both at the project and at the portfolio level. So I think there are some good examples of some structures that have been put together. The EGO fund that was put together to buy green bonds from financial institutions and really bring retail investors into that. So a Belgian pensioner or a Belgian dentist can buy for his pension green bond funds through EGO. And again, that was using a little bit of blended finance, a subordinated position of the MDBs, and then the top tier being a AAA or an A-rated instrument that an institutional investor could buy. I think similar structures like the MCPP, so the syndication portfolio that IFC built, was very useful. And then I also think about, I don't know if you've looked at the structure of the IFU, which is the Danish development finance institution. But in essence, what they've done is they've taken government money, then they've added pension money to it. And there's an agreement in the waterfall of how the returns get paid out. So the pension funds get paid first up to a certain return, then IFU gets paid up to a certain return, and then they share what's on top of that. I think that's a very interesting way to think about blending in a way that will attract private capital while we solve some of these regulatory issues.
Thanks, Stephanie. And I do know the Danish case. In fact, we wrote a case study about it. So perhaps my colleagues could put a link to that case study, because you're onto something. It was a very structured way of covering risks and returns between the Danish government and a set of Danish otherwise institutional investors who otherwise would not touch the subject matter of the investment fund. So it's
and you're seeing the same thing. The Dutch pension funds through ILX are actually buying positions in B loans. And that, the first $1 billion that they've invested has performed extremely well. And again, these are the examples that we need to give back to regulators so that they can give some forbearance to commercial banks to use those de-risking tools.
Right. So basically you're saying it's a prohibitive for institutional investors to do long-term projects or investments in the developing world. We need case points to convince regulators to change that dynamic, and blended finance can be part of the laying out of a proof point. So I understand where you're going with that. Let me turn for a moment to Cecilia Tam at International Energy Agency. In our report, we mentioned a report that IEA did in conjunction with International Finance Corporation to estimate how much concessional money, this is not blended finance, but just the concessional money, would be needed through 2035 for the net zero emissions scenario that IEA has put out. And it's a lot of money. You're talking about $83 billion per annum of concessional funding up to 2030. And then from there to 2035, over $100 billion needed to deal with, to try to get to a net zero emissions scenario. Our estimates, based on your work, suggest that you may even have lowballed the amount of money needed, in that we look at the amount of private sector investment mobilized historically by each concessional dollar in blended finance. And we worked out the math and put that in the report. And essentially, you need a lot more concessional money aimed at blended finance to achieve the scenario that you've painted. So my question for you, Cecilia, is to mobilize the private finance that is needed to hit your net zero emissions projections. What does blended finance have to do differently? How should the very limited concessional money that's out there maybe be used more efficiently to leverage private finance? Can you comment on that for us, please?
Sure, thanks, Joan, and thanks to Convergence for the invitation to join the panel, and congratulations on the release of this new report. Maybe just one point of clarification in terms of the amount of concessional funding needed, that 80 to 100 billion that we identified or estimated. That's really just focused on the amount that can mobilize private. We were not able to also quantify the amount of concessional funding that's required that may not be able to access commercial finance. And this is particularly important when we're talking about public utilities. So that 80 to 100 is sort of a low estimate, which is, the point that you made at the start. In terms of the work that we've been doing, where we see opportunities for blended finance and public money and concessional funding to mobilize much higher levels of concessional funds, would really be sort of 4 or 5 points that I'd like to highlight. So this need to shift away from direct project financing, because obviously with very limited amounts of public money, we need to hit much higher leverage ratios. And our feeling is that where markets and for technologies that are more mature, a greater focus on guarantees for direct project de-risking through first loss guarantees or revenue guarantees, for example, to address risks around the credit worthiness of off-takers, particularly public utilities, where that's a concern, can have a much more catalytic impact and realize much higher leverage ratios than a focus on using limited concessional funds for direct financing of projects. Linked to that, many of the blended finance transactions include concessional as well as non-concessional lending by MDBs together with third-party financing. And what's not always clear, in our opinion, is whether the level of co-financing on commercial terms is needed to mobilize third-party financing or not, or whether, in fact, it could be potentially crowding out private finance. And if a use of smaller amounts of concessional funding and or lower levels of co-financing in structures isn't enough to de-risk projects and bring in more private money. So linked to that, we need to really have a better understanding of the impacts of blended finance transactions and structures to more effectively design these types of interventions to maximize the level of private capital mobilization. And I think having more platforms to share country and institutional experience, including on increasing the amount of data available to help us identify good practices as well as lessons learned, can really help to improve data transparency and help investors gain confidence and better evaluate project risks and returns that will lead to higher amounts of private capital mobilization, and really work towards overcoming perceived risks that can lead to higher levels of mobilization as well. And then, some of the blended finance facilities and structures have focused quite a lot, I think, more on international private capital versus domestic. So I think greater cooperation with national development banks, for example, could help to focus mobilization also on domestic private capital, which we feel, and I think this was mentioned by one of the Convergence speakers, can really help to mobilize much higher amounts of private capital and also mobilize domestic savings, because we also need to see benefits for domestic markets and help build local capital markets that are critical to hit the trillions that we're saying needs to be invested in energy transitions. And then perhaps final point that I would make is that we hear, and I think this is something that has already been mentioned, that there really is just a lack of bankable project pipelines, as well as structures that would allow investors to participate in financing, at least in the case of clean energy projects. So using blended finance facilities to support project preparation, as well as project structuring, for example, by pooling smaller projects into investable scales for institutional investors, and we believe would help address some of these major barriers. Thank you.
Thanks, Cecilia. And you're singing my song when you talk about better information and sharing of experiences, a way to overcome one of the issues you're flagging, which is the imprecise application of concessional money toward blended finance, and perhaps over application in some places, less than strategic in the other. And we keep urging that more information be shared on how blended finance deals were structured and what the terms were, so that everybody can learn more effectively. We don't have a lot of time to waste. So you're singing my tune. You actually teed up very well the next speaker I want to invite into the conversation, Thierry Watrin from the Ministry of Finance of Rwanda. We're delighted to have the Rwandan voice here. We strove in our report to try to bring out the voice of more of the countries of focus, and not just the voices of donor countries and international investors. So you mentioned just now better collaboration with domestic actors. So let me invite Thierry in, and let me ask you, Thierry, if I may, Rwanda, you launched a new facility, a green investment facility, Ireme Invest, in COP27. I was there, and I was honored to be in the room when your president, Paul Kagame, launched Ireme. What challenges has Rwanda faced in mobilizing domestic capital, the domestic private sector, into climate projects? How does Ireme Invest look to address those challenges? Can you walk us through a little bit of what's going on in your country?
Thank you, Joanne. Actually, I think, as you said, that Cecilia's voice is the perfect transition on sharing information and peer-to-peer exchange and mechanism on how it works, actually. So what we did for Rwanda is we launched the Ireme Invest, which is a green investment facility and more easily a green bank. How does it work? It's a $300 million facility. And the first round of capitalization was 100 million when it was launched last COP 27. It's a two-armed investment facility. On the first arm, you have the Rwanda Green Fund that's doing a project preparation facility. So the goal is to identify our startup and our SMEs, roughly speaking. In Rwanda, similarly to Africa, around 98% actually of our private sector are composed of SMEs. So what it means that if we talk about the private sector, we talk about the SMEs. So we need to design a blended finance instrument for our SMEs. So that was the spirit of the Green Bank. So that's the first arm that was done by it's a consortium, right? So the first arm is done by the Rwanda Green Fund about the project preparation facility. Then you have the credit facility, which is done by the Rwanda Development Bank. And I think it was Stephanie who talked about the development bank and the national banks. I think it's the best example on how to scale up, because what we see as well is that 80% of SMEs in Africa actually fail to go to big companies. So there's a big step between being an SME, a green or non-green SME, and going to a big company. for different reasons. And one of the answer that IREME Invest does, and it's partly as well encouraged and financed by the Rwanda government through the Resilience Sustainability Trust of the IMF, I'll come back to that after, is really a public willingness to finance and to encourage the private sector by providing a total life cycle of a company, from the stadium of startup, then to SME, and then to a big company. But you cannot lose the information, right? You cannot have your green fund that just provide the grants for the company to start, then the company is lost and needs to go to borrow on commercial terms to grow. Like the current financial state of the world with a strong dollar, high inflation, high interest rates. Already for developed countries, SMEs, it's difficult. So imagine for Africa's SMEs to develop. So what we did actually is that we used the Green Bank to reduce the cost of financing for our private sector, and especially on sustainability and green categories, I would say. And so that's the perfect example of how do you use blended finance, because we use public financing to reduce the lending rate for the private sector from around, if you go on commercial terms in Rwanda, for example, it's between 16 and 18%. We're able to reduce it to between 6 to 12% for the different companies. And that's a real incentivation for the private sector to move to sustainable and to green condition. But without the public sector enabling it, it was almost impossible. And so the Green Bank was the response actually to our private sector concerns about the cost of financing, about the difficulties to grow up, and about how to have a safe actually ecosystem home to be able to scale up, right? And so about the structural financing, it's a bit technical, but how we did it is that a year before, in 2022, we had been selected as the first African country ever to receive the IMF Resilience Sustainability Trust, which is a program that rechannel the SDRs, the special drawing rights of a country, towards its financing and its budget. And so thanks to that, we're able to access to $319 million, which is quite a substantial amount. And we're able to make the case for our budget and as well our private sector to finance key facilities like the Green Bank. And also, once we accessed the RST, we went back to Paris Summit, June this year, to scale it up, because we were like 319 million is great, but you have always a factor from 1 to 1,000 on the climate investment gap, for example. Like we always hear we need trillions, we receive billions. In Rwanda, we need billions, we receive millions. So in the end, we're like, okay, how do we go to the billion, right? That's the key question. So we went back to Paris Summit, we prepare and pitch actually our idea on how to scale up climate finance. And we reach another $300 million. So that makes around 619 million USD for the whole facility. And there you have a massive amount that helps you to reduce cost of financing, to target your companies and to grow your private sector. And I think that's one of the best case actually for blended finance that we've been able to do. And it's quite rare, I would say, because I've not seen many countries that have been able to do that for different reasons. But in Rwanda, we've been able to do that. And I think that's an interesting example of a successful blended finance case.
Thanks, Thierry. Yeah, there are a lot of elements in there. First of all, identification that you need longitudinal support to these SMEs as they grow. Identification of SMEs as your issue, as opposed to another country, which might be in a different moment. the sort of the smart application of a large international program, in this case, the IMF program, but with the shots being called by the country that knows what it needs. So that I think all of that is really great for sharing. And I'm hopeful that there will be sharing among countries who are doing these things, as opposed to there being some kind of hub and spoke system of, something gets done in Paris and repeated. I think having something originate in Rwanda is useful for someone in another country, even if it's far away, if it's dealing with similar challenges. I think you might relate to each other more directly in a way that's incredibly powerful. Thanks for sharing that. I'm going to Jayco next, because one of the things about writing about climate is that you end up discussing sort of two universes. One is the mitigation side, one is the adaptation side. We did talk about hybrid deals, and the question somewhere, there's a question of what do you mean by hybrid? And we're talking about transactions that cross over between objectives. But Jayco is a managing director at Lightsmith Group, which is a private equity fund manager that has been dealing with adaptation and investing in it and leading in that field. So Jay, Terry actually just mentioned the subject of pipeline and creating a pipeline of investable transactions. Do you want to talk about how you do that in this specific space in the adaptation side? It's a bit different from going around and finding solar plants to invest in, isn't it?
Yeah, thank you very much, Joan, for having me, and really appreciate the inclusion in the report. I think it's one of the great gifts that Convergence gives to the entire community, is to kind of give a state of the state on blended finance and how important it is in the climate context. So as you mentioned, Joan, Lightsmith is the sponsor and investor of the CRAFT Fund, sometimes called the Climate Resilience and Adaptation Finance and Technology Transfer Facility, which is considered to be the first private investment fund for adaptation and climate resilience. It is a blended finance strategy. So it has a junior layer of equity supplied by a combination of multilaterals, individual governments, and philanthropy. So the Green Climate Fund of the UN itself is the single largest investor in the fund, that provides a concessional layer, alongside the Nordic Development Fund as another multilateral, the government of Luxembourg, and then Rockefeller Foundation under the philanthropic community. So it's a successful example, I think, of the launch of adaptation finance in the private sector. At $185 million, it's 37% of tracked private investment in adaptation finance, which is sort of shockingly small. And alongside the fund is a technical assistance facility supplied by the U.S. Department of State and the Nordic Development Fund. So again, we have both a junior layer of equity and an aligned grant facility, which is really aimed at accelerating the deployment of those technologies into low-income countries and small island developing states. The adaptation problem, I think, is one in part of conceptualization and then of scale. The conceptualization problem goes back to analysis done in 2014 by the UNEP, the Adaptation Gap Report. So most people have no idea what adaptation means. The private sector certainly doesn't know that word. The private sector typically describes the results of adaptation or resilience really as reliability or business continuity or risk management or risk underwriting and risk transfer. And so a key consideration in moving adaptation forward in mobilization of finance really is, how do we define what adaptation means? How do we define what climate resilience means in a way that's actually practical and investable? So I dropped a link into the chat to a 2020 analysis that was done as part of the ASAP project that is an adaptation solutions taxonomy, specifically for, in that case, developing countries and SMEs, that outlines an approach that was peer-reviewed and released in 2020 that says, look, if we can find a climate hazard or risk in IPCC or the literature, and a company that can actually either assess that risk or help to manage that risk, we can describe that company as an adaptation or climate resilience company. We're in the process right now of a project that we'll be publishing at COP28, supported by the Bezos Earth Fund and ClimateWorks Foundation, at Lightsmith and at Gary, that really updates a framework for identifying adaptation companies as a unit of potential target for investment, whether they're at early stage companies all the way through publicly traded companies, and also doing some feasibility analysis around whether or not there are a universe of public companies out there to invest in. The second point really is about scale. So we were able to launch the first private investment fund for climate adaptation and climate resilience, and reach first close in 2019 and final close in 2022. That's $185 million, or over 50% invested in that fund at Lightsmith. And the question is it going to take us another 6 or 7 years to raise another $185 million, in which case the scale of the problem that we're facing on the adaptation side of things will be dramatically larger. And yet the path to scaling up capital, even using blended instruments, will remain relatively linear. So I think in terms of the question of how to actually address the adaptation problem, I'd put forth 2 suggestions. One, adaptation is not an object in space. You don't go up in the morning and buy a loaf of adaptation or live in an adaptation or power your car with adaptation. What you do is you buy food that is adapted or resilient to climate change. You buy energy that is adapted to climate change. You live in shelter that's adapted to climate change. You secure healthcare that's adapted to climate change. You secure water supplies that is adapted to climate change, just as all of those things are also low carbon. And so I think what we're really seeing in our investments are both GHG benefits and adaptation and climate resilience benefits. I think this kind of artificial division between adaptation and mitigation will go away. The future of the world and of climate action is not a tale of 2 islands, like mitigation island or adaptation island you get to live on. We're going to live in one future. It must be climate resilient and it must be low carbon. And so I think that's what we're going to see going out there. I think the 2 things that I think I would leave as a challenge that come out of the Convergence report are we're really happy to see the recommendation around scaling up DFI and MDB activity around climate action and blended finance, as well as the second point around really integrating philanthropic capital more directly into the equation. We are out of time, and that's the last point that I would leave here as kind of a way to kind of go forward in adaptation finance and really what we think of as the climate 2.0 approach, which incorporates both mitigation and adaptation. And that is we need dramatic amounts of scale at this point. Innovation, particularly in the early stages of the development of an area like adaptation finance, can come in small increments, right? So small grants led to the launch of Lightsmith's Craft Fund from the Global Environment Facility to the Nordic Development Fund. Small amounts of junior capital has resulted in mobilization of $185 million in private investment for the first private investment fund in adaptation and climate resilience. If we repeat small amounts of increments in blended finance, we will get small amounts of mobilization, and we do not have time for that any longer, right? So the difference between climate, particularly on the adaptation resilience side and other areas that we think are critical, are that the rate of change and the comparative business as usual case is not stable, right? If we do not act on adaptation and climate resilience, the world will not remain at kind of like a relatively static or linearly degrading level. It's going to rapidly decline. We're seeing that already just in the last year, and we will see an acceleration of the rate of climate risk and impact. And according to the IPCC SIC, that is likely to potentially reach geometric or nonlinear impacts. That means that every year that we delay scaling up capital is lost to increasing risk and impact, particularly to the most vulnerable populations. So my charge to everyone is in following those initial recommendations of Convergence in the MDB and DFI space and in the philanthropic space, not to have linear growth in the deployment of blended finance against climate action, in mitigation, and certainly not adaptation, but to have geometric growth in this. We need to mobilize blended finance, not to go from 185 to 250, for example, in adaptation finance, but to go from 185 to 500 or $1 billion or doubling every year, because the scale that we need capital to be mobilized now, particularly for adaptation finance, is not a linear demand. It is a geometric problem. We need billions and billions and billions of dollars of capital to be thrown against $1 trillion problem we've created for ourselves. 2030 is less than 7 years away now. We're going to have dramatic amounts of impact that's going to scale over that period of time. So I think one challenge I would add to the design equation on blended finance is not just to think about this as blended finance at a moment in time, but blended finance for scale, to accelerate the speed at which we're mobilizing capital. And I would call for doubling or tripling or quadrupling of the amount of commitments, particularly in adaptation as an area for MDBs and philanthropies. We shouldn't have less than $500 million of private investment in adaptation finance. We should have $1 billion by next year or $5 billion by next year. And that's the question I think that we should all be thinking about as we run up to COP28.
Thank you, Jay. Yeah, I hear 2 calls for action in your remarks. One is the speed and the geometric increase. and the other is to get rid of the columnar or siloed approach of this is mitigation, this is adaptation, this is philanthropic activity, this is investment activity, and this is DFI activity versus something else. So you're talking about actually tighter collaboration as well as greater speed and total volume of financing. So I hear two different themes there. We are short of time, and I do want to leave some room for the audience to ask questions. But I did want to ask one question of perhaps two of you, if I may, because we haven't touched on it yet, and it's local versus foreign currency investing. And in this particular climate we're in, I think it deserves some mention. So I'm going to ask Terry from the Ministry of Finance of Rwanda to comment on what countries like Rwanda are doing to deal with local currency versus foreign currency risk. There's a lot of talk about whether blended finance can step in and do something there or not. So I want to ask Terry. I also would love to hear from Stephanie on that subject, what a large commercial bank like Citi thinks blended finance might be able to contribute for that specific risk. So may I ask Terry if you would go first?
Thank you, Joan. Actually, it's true. I wanted to talk about that, but I spent some time explaining really the context of the Green Bank.
Which is
I think
great.
for a lot of people, yeah, it's not obvious. So I like to provide some context. Actually, recently, a few weeks ago, we launched a local sustainability-linked bond in local currency. So in Rwandan francs, the equivalent of $30 billion, and in local currency, 30 billion. The good news was that I think it was launched on the market Friday last week, and it's already oversubscribed, which means that the investors have an appetite for that. Mainly what we see is that the investors are local banks, local pension funds, or East African investors, as what we can see. And the goal will be in the future to extend the base of investors to get buy-in, right, in the local currency solutions. So how do you pitch actually your local currency solution? First, you need to go small. We started by a 30 million sustainability-linked bonds to be sure to be able to deliver on the use of proceeds, on how do we use the money that comes from the bond, and how do we report through the ICMA. It's an interesting solution for our private sector because the local price for that is way below the currency solution that would have been in dollars, for example. And I was giving the context about the strong dollar. Now it's even worse. So if we go to the market and we take a bond at 7%, let's say, and 7 to 10 years maturity, when we go back to Rwandan francs, we add another 9%. So we're directly at 16% already. You add the management fees, you're at 18%. So that explains you, I was talking about the commercial rates in Rwanda that are 18%. The FX rate is huge. It's almost half of the interest rate of the country. So for us, being able to issue a local currency sustainability-linked bond was instrumental as a first step to move away from orthodox financing and to prove that we can actually do it. And for our private sector, it's actually the best. So you need to provide an element of sustainability, of course, to be able to access the financing. But in the end, you have a guaranteed financing of 11 to 12%, between 11 and 12% for the private sector. So it's still 6% under the market, right? So that's a no-brainer for our private sector. And the difficulty, I think, for us was to convince investors that we can make it, but having the brand of Rwanda and being very advanced on climate and sustainability agenda, and having it was backed by the World Bank and as well the Rwandan Development Bank who issued it. It's state-owned. So in the end, we do not fail and we deliver. But still, even for us, and we are rating B+, and our economy and debt levels are super healthy. Still, even for us, it was difficult to get the buy-in of the investors. So we started small in terms of amount. But as soon as I think it's the first step, we're going baby steps, and we want to scale up in the future. And to get the buy-in of international fund manager, trust manager, pension funds manager, to make the case that if you invest in local currency, actually, if the economy is able to deliver, you actually only take the sovereign risk, right? Like the local currency risk is not that different to the sovereign risk. And so for us, it was important to make the case, and for our private sector, maybe to explain what we were doing as well, and make the case. But yeah, so that's what we've been doing. It's super recent, and it works, actually. It's a good example.
It's a great example. It does require your sovereign government to have a particular rating. And maybe that is where blended finance can come in, is in places where that is not true. I'll leave that there. But Stephanie, do you want to comment from a completely different perspective on the Forex issue?
Yeah, Joan, let me jump in. So I might sound like a pessimist, but I think the first thing I would say is FX risk has always been present in emerging markets since, you and I have been doing this for 30 years. It's not the only risk. And I worry that in the dialogue, in the last 6 months, it has become the elephant in the room. And if we can just solve for FX, the money's going to flow. And I've seen some of these proposals to create whole new institutions and whole new facilities where we throw lots and lots of donor funding at them to, in essence, subsidize, the FX risk. And I worry that distorts markets in the long run. And two, it really makes bad policy non-transparent. And, there's a reason why exchange risks exist, right? And we need to uncover that policy. So my preference would be rather to say, okay, what's out there that exists today that we might be able to do a little bit more with? I think TCX is a fabulous example of an organization that runs well, that could use more capital. They could think about pools of FX that keep us on the curve. That's one option. Another option is to actually take the private sector window, the IDA private sector window, which has a special sub window to help with FX risk in the lowest countries of the world, and make that more available to all the development institutions, not just to the IFC and MIGA. And then I would say, one of the coolest things that we're doing at Citi, and I'm really proud of this, because a couple of people have talked about SMEs and the importance of SMEs. And to layer FX risk into an SME is not the right thing to do. So we are capital constrained. And when I was looking around the world, I realized that there were about 50 countries, all of them in emerging markets, where our risk-weighted assets, so the capital we have to set aside for our excess liquidity, is actually somewhere between 100 and 150% of those that excess liquidity. So I said, why are we putting this in the central banks? Why are we not loaning this to the development finance institutions who are AAA rated, and let them on lend it to SMEs, either through banks, or into climate projects? And so we have actually started a new program at our international treasury level to say, in our 83 franchises, anywhere we have excess liquidity, can we actually move that to a AAA rated agency and let them use that? And some of the deals that we've structured are somewhere between 5 and 7 years. So it's not short-term money that we're considering lending. It's got a long enough maturity that it can actually add value to the conversation.
Very cool idea. Thank you very much. Let me go to the audience to make sure that others get a chance to throw questions at you, because I could do this all day and have a great time. But I think, Andrew, do we have other questions that you would like to bring out from the chat?
Yes, Joan, sorry for the delay. We have a question here on relating to local currency financing. So basically how to convince governments to allow for local debt issuance from higher quality issuers. The challenge with local currency financing is that when you're trying to scale local currency financing by pulling local currency in a country. You can follow Rwanda and issue a bond, which is a great idea, which the World Bank did in 2017. But the pushback from local governments is that they don't want the World Bank in the market with a AAA rating issuing debt because the bank crowds out the government with a higher rating. So the question is how to convince governments to allow for local debt issuance from high quality issuers, and whether there are any good examples.
Okay, I'm not quite sure if it's a blended finance question, but I guess it is a question of crowding out of market players. And I don't know whether, Terry, you feel equipped to answer that question. What is it you've done, or what is the thought process you've gone through inside Rwanda to try to figure out how to move from having AAA rated institutions issuing bonds to, cultivating an active local market?
Yeah, on the case of Rwanda, it's not the World Bank who issued our sustainability linked bond. It's the Rwanda Development Bank. The World Bank actually was having the approach of a blended finance supporting institution by providing the guarantee. So the guarantee is a AAA, right? And that's how we go on the market and try to convince investors that actually the bond is under control and that you can invest without having a huge risk of default. And the FX risk actually, or the FX devaluation, is pure projection of balance of payment, right? Because depending on your balance of payment, your currency will evolve differently versus dollar, right? Or euro, depending on where you are. And so that's a risk that investors calculate actually when they look on the return on investment for the bond, for the bond. So I think, yeah, that was a bit how we pitched it, and it worked because it got oversubscribed.
And it was not
Joan,
blended.
can I jump in here 1 second?
Yeah, absolutely.
I mean, I do think that it's very difficult to convince governments. And I in my old hat at IFC, I was working on the Ukrainians. But it's not necessarily a silver bullet. And I say that because I think both Cecilia, well, everybody's talked about the fact that, there's not enough projects out there for us to finance. So if you're a development institution, and we've actually IFC did issue a bond in Rwanda. And it's a great example where we issued the bond. We didn't have enough projects in our pipeline to actually use the pool of local currency that we developed. And then the local currency got stale. And so, the projects were looking for a different pricing point than we were able to give them. And so I think and I've actually done transactions where you've done a bond that's back to the project, which means a lot of heavy structuring on the project side. This is one of the reasons why I love this product that we're working on at Citi. It's basically a line of credit. So when the development institution has the project, they come and draw. And if we can encourage other international banks that are holding liquidity in markets, I think we may be able to see more of that happen.
Yeah, I actually like the fact that we've strayed a little bit from a blended finance discussion here, because the whole point of blended finance ought to be to do things that cannot be done through other ways. And a couple of things that have come to light in the most recent couple of minutes here have been other things that are not blended that approach a problem well, or potentially even better. I realize that we're almost at time. I wonder if I could ask Cecilia maybe for one last question, because I want to take advantage of her being part of this conversation. Are you, what do you think that, when you listen to this conversation, what do you think the MDB community and local governments can all be doing on the energy transition side? How can, for example, MDBs better support the energy transition moves of national development banks? Do you have a comment on any of the things that Stephanie or Terry were mentioning just now?
Sure. Thanks very much for the follow-up. I mean, I would say that, a lot of the changes that we're seeing at the MDBs are slowly happening. But I think we all probably would agree that, some of these reforms aren't happening quick enough. So there is, I think, a role for the MDBs to play, and that they are doing this, but in terms of helping to build capacity locally, as well as helping, countries set up the right types of structures that would allow much more standardization in project development. And so, a lot of the work that we do at the IEA on policy strengthening and reform is really aimed also around building local capacity. I think we talk a lot about the need to facilitate project structuring. And I think the MDBs are well placed to help develop and design standardized products, whether that's standardized power purchase agreements that are easy for investors to understand, is one area that I think is quite important. The IEA plays an important role working with a number of key emerging and developing economies to strengthen the policy environment. But the MDBs have a much larger reach locally to help, I think, help scale that in terms of ensuring that the policy environment is suitable in these countries for investments, and then playing a big role in helping to build project pipelines. I think we all talk about the need for them to be able to take more risks. When we talk to, I think, the private lending arms of a lot of these multilaterals, they still come to us and say we have a scale problem. So partnering, I think, with local green banks, local development banks, can really help solve some of those issues, because it's really the local financial and the public financial actors that can help overcome some of these issues. And we're seeing a lot of very interesting activity. I'm not sure they necessarily have a blended structure, but you have IREDA, the India Renewable Energy Development Agencies, that's about to have an IPO. And I think interesting interventions like that will be quite interesting, and whether the MDBs will have a role to play there will depend on how much demand there is for that IPO. But you see a lot of interesting structures like that happening. In Indonesia, you have SMI that has this big SDG1 fund. So I think there is a need to follow this more carefully and make sure that there is a better flow of information and data on how these different innovative nationally driven solutions, country platforms, are really being able to be more catalytic in terms of being able to provide that pipeline of projects or structures that's going to be necessary to get the scales that we need for investing.
Right.
Joan,
Yeah.
I've got to jump off really quickly on another call. But one of the things we didn't get to touch on today was the jet fees. And I would love to have a follow-on conversation about, I'm very deeply involved in Indonesia and Vietnam, and kind of what their potential is and what we can learn from what's happened in those early jet fees in terms of how we structure them going forward.
You realize you've just volunteered for something.
That's fine. No, I'm happy to help.
Take you
because
up
they're
on that.
important.
Thank
But anyway,
you.
thank you very much.
And let me close out because I want to respect everybody's time. Thank you, my panelists, our panelists, very, very much for your comments. You reflect a lot of different corners of the community, and you spoke very eloquently on behalf of the community of blended finance and climate finance. Look, we intend the State of Blended Finance to be a data-driven call to action. We hope we've accomplished that much. We just think that blended finance is not being used nearly at the scale or with the effectiveness needed to hit its potential. To Jay Koh's point, we do not have a lot of time. We need geometric change. We also recognize that blended finance is a subset of development activity and equally a subset of investment activity. And we've tried to draw out the patterns that we're seeing that to try to reflect broader movements in both of those fields. You'll notice that there are shifts in blended finance that we're recording. There are actually shifts in other things going on. We've tried to bring that out in the report. We encourage others to cite the report, draw on it, share your own findings, and come back to us with opposing and other views. We love to hear from folks. We are in our basic nature, a network of all of you. So we hope we have done a decent job of reflecting all of those different voices, but we would love to hear back from you. And we want to thank the many institutions who've shared data and insights that made the report possible. So on behalf of all my colleagues at Convergence, on behalf of the audience, to the panelists, thank you very much. Thank you all, and have a great day. And please let us know what you think of the report and how we can improve on it in the future. Thank you.